This video shows you what to do when you need to send goods back to the supplier and how the accounting works. There are two common scenarios when you need to send goods back to the supplier. The first is where you've been sent more than you ordered and you don't want them, and the second one is where you've got damaged or end-of-line items and you want to send these back to the supplier for a refund. So let's take the first scenario. You've been sent more items than you ordered. You've not yet received inventory and you've not yet been invoiced for them. This is key because once you've received those extra items and you've been invoiced for them, things get a bit harder. In that case, we'll be using the second technique, which is what happens when they have been invoiced. So the first step is to only receive the quantity you ordered on the purchase order. Then just speak to your supplier and send the extra items back so they never go into Brightpearl. Receive the invoice against that purchase order for the number of items you've received into stock. And then if your supplier is going to credit you for any shipping credit, then raise that as a separate supplier credit. Here's a purchase order we've placed with the supplier for 4 items. Let's say when the boxes turn up, we've actually got 5. We'll phone our supplier, confirm that we're going to send that extra item back, and then go to receive the inventory. We'll make sure we only receive 4 into stock, and then we'll simply ship that extra item back to them. When they send us the invoice, we'll confirm that it is for the 4 items, and if it's simply for 4 items, we receive the invoice against the purchase order. If, however, they've put a discount or a credit onto that purchase invoice for shipping, what you can do is you can simply add a row, put shipping discount or shipping refund, put 1 in the quantity, and then a negative in here for the price they're refunding you. So let's just say they're taking $1 off. Save the changes to that and receive the invoice in the normal way. If your supplier sends you the credit as a separate document, so not part of that original purchase invoice, then we'd recommend using vendor credit or supplier credit. Enter the supplier name, choose the date, and of course the credit number, which is theirs. Put any details you like in here, so maybe credit for shipping, put the amount, whether it's taxable or not, and then choose which account code it goes into. You'd probably want to use a 5000 code, so here for example we've got freight and shipping costs, and then enter that into the accounting system. You can either use this credit to pay off a future invoice, or if you're actually going to receive money from the supplier, record that via accounts payable. And if we go into the account for the blue supplier, we can record money received into our current bank account for the credit by allocating a payment. The recent activity for the current bank account, which you can get to from here, shows that we've just received a deposit of $250. The next scenario is where you've got damaged or end-of-line items, and here's where you have already received the goods and you've received the purchase invoice. Perhaps you want to send these goods back maybe weeks or months after they first arrived. The first step is to create what we call a purchase credit to track the financials, and that's a bit like a purchase order. You can't add inventory items to a purchase credit, so what you need to do is make an inventory adjustment for the product to remove them from stock. You then allocate this credit against the supplier account, and then if there's any refund that's coming back from the supplier, record that against your system too, to show the money coming into your bank account. At the start of the season, we created a purchase order for a supplier for 10 flannel shirts. We received all the items into stock, and then we received the purchase invoice against the purchase order. It's now the end of the season, and we've come to an agreement with the supplier that we can send them back for a full refund. There are 2 parts to this process. The first is the financial side of it, and the other is the inventory. So for the financial, let's create a purchase credit. Unlike a purchase order, however, you can't actually put inventory items on, because when we're going to send them back, we want to override the first in, first out process, so we're going to do a manual inventory correction. So just type in the product name here. Good idea to put the SKU in as well. Choose your cost of goods sold account, and make sure that's the same one that you've got set on the product. My products weren't taxable, so I'm just going to put that to blank, and then put the quantity you're going to return and the price you've agreed with your supplier. The next thing we'll do is actually send the goods back to the supplier. We're going to record the decrease of inventory as an inventory correction, and that's done from the inventory detail screen. In your system you'd have a load more lines on here, so what you'd do is you'd filter this probably by SKU or name. Choose the items that you want to return, and if you've got multiple items here, choose the one at the relevant price. Click the pencil icon by the in-stock quantity, and then type in the quantity we're going to decrease by. Enter a reason, let's just go with end of season, which will remove the items from stock and create an accounting transaction to show your asset is decreased. When you later receive the credit paperwork from your supplier, go to Purchases, All Purchase Credits, and open up the purchase credit we've been working with. Click to receive credit, enter their credit reference, which puts the total balance of this purchase credit onto the supplier's account. And because we never paid for that original purchase invoice, that's cleared down the balance. You probably also want to update this purchase credit to something called complete, so create some extra statuses like the ones I've got here. That's the process complete. Now let's see how that looks in the accounting system. So we'll go to the general ledger, which is where all of our accounting transactions are stored, and at the bottom we can see that we've received the inventory. So we've increased our inventory, and the balance of that is on inventory received, not invoiced. Then when we received the purchase invoice against that original purchase order, that balance has been moved across to accounts payable. We didn't pay the supplier, so that's where it's going to stay. The next transaction is the inventory correction at the end of the season. So we remove 10 items, each at $1, and what that's going to do is going to decrease the inventory, so there's a credit on your inventory code and a debit on your cost of sales. And then finally, when you credit that purchase credit, that's where we recorded their credit reference against it, it's transferred funds from the cost of sales back onto accounts payable. So the balance on the accounts payable is 0, the balance on the cost of sales account is 0, the balance on the inventory is 0, and we're back where we started. And we can see this on both our income statement, which is also called the profit and loss report, no transactions there, and we can also see it on the balance sheet, no transactions there. If you're getting a refund from your supplier at a different price that you originally paid for them, then you'd show a profit or loss. There are 3 other videos that are well worth watching: accounting for purchase orders, foreign currency purchase orders, and paying your suppliers or vendors. Which takes us to the end of the video where we see how to send goods back to our supplier.